all. Peter, you and I just had a brief discussion, but you're an economist with the American Institute for Economic Research. You've been in the markets as a trader, an analyst in financial markets in Wall Street for about 20 years, I think. And your research focuses on financial markets, monetary issues, and economic history. I mean, I can say more, but maybe that will just emerge, the rest will emerge in the course of our conversation. Daniel, you have a PhD in economics, you're a professor of global economy and a financial analyst with a postgraduate degree in economy investigation. You're the author of several books. I'll mention just one, which is The Financial Market. Well, maybe The Energy World is Flat is a good catching title. And then Thorsten, you're the chief economist at Europe's largest precious metal trading house. And before that, you worked for 15 years in international investment banking. Again, there's quite a lot more I could say about all the three of you, but maybe we should let that emerge in the conversation. It's my job to sort of get this thing going, and then after a while, to ask you some questions, and then we'll invite questions from, so to speak, the floor. And my questions are all going to be rather simple Simon questions, because we're not all monetary economists. But given the unique circumstances of the pandemic, what, in your view, should government be doing in or through monetary policy, either as a positive monetary policy to change things, or as an accommodating monetary policy to be able to do so that government can do the other things you think it should do? Peter, you came in first. Why don't we ask you?
So I had actually written some things down here. I mean, what I'd start by saying is that, right now, at least at the onset of this, the original amount that the Trump administration budgeted to fight the coronavirus was $2.5 billion. That amount in about 90 days has reached over 6 trillion. At least in textbook terms, an expansionary monetary policy is useful in offsetting slowdowns that occur due to negative aggregate demand shocks. But what we're seeing is a negative aggregate supply shock to the extent that we have supply chains and closures of business and all that sort of thing. So I've been watching what the Fed has been doing, and I've come to one of 3 conclusions. One is that the first is that they have no idea what they're doing. The second is that they've misdiagnosed the problem. And the third is that they're trying to leapfrog the economic crisis, which is the negative aggregate supply shock, and jump ahead using the tools they know the best because they've used them the most to address a not yet arisen, but possible negative aggregate demand shock, which essentially is they're basically trying to forestall the Lehman moment before it happens, rather than addressing, say, the tremendous slowdown, the almost complete seizure of GDP, which, by the way, is not a product of business cycles or anything like that. It's imposed. So I actually find it very difficult to figure out why. I mean, I have theories, but it's a little, what they're doing right now, in my mind, is a little counterintuitive.
Thank you. Daniel, could I ask you to come in here, respond perhaps to what Peter said, but maybe also deal with the question I asked before, just a general question of how should governments handle this in monetary policy terms?
Mm-hmm. Well, thank you very much. I agree with everything that Pete was just saying, is that we are, what governments and central banks are doing right now is addressing the 2008 crisis with the tools of 2008, but with no idea of what the real diagnosis is, which starts with a problem. The problem is that first, governments believed that previous monetary policy was working. We already saw the slowdown in the Eurozone, slowdown in the US economy. The diminishing returns of monetary policy were already pretty evident, fundamentally because there's a point at which you bring rates from 1% to 0, you're not going to incentivize more demand, and actually the demand that you're going to incentivize is likely to be malinvestment. So what should governments do in this environment? I know it's very, very hard to say to governments and to central banks, you should do less, but it's actually what they need to do right now, because as Pete was also saying, this is a crisis that has been imposed because of the lockdown of the economy decided by central policymakers. So the idea that you're going to generate demand or that you're going to incentivize demand when the economy is shut down through imposition makes no sense. But the idea that level of liquidity would generate improvements in productivity, growth, and jobs is even more ludicrous fundamentally, because the little demand that you're actually going to incentivize will not be followed by supply. So from the perspective of governments, what they should address is the lockdown from a supply side perspective. That is fiscal. They need to, if they close the economy, they need to eliminate taxes, at least throughout the period in which the economy is shut down. You cannot have administration of boom times with depression economy in the real economy. The second thing is that obviously this enormous fiscal space that is being generated already has massive liquidity from the side of central banks. So the biggest mistake that central banks can do is what they're doing right now, which is to bail out the old economy, to bail out the past and let the future die. So my concern is that actually what they actually should be doing was to take supply side measures, reduce excessive spending, and reduce taxes in order to accommodate the hibernation of the economy, as well as the increase in spending, either because of unemployment costs or because of social security costs. And the central banks should maintain the situation that they have right now, but not increase money supply aggressively. Why? We are seeing it these days. Money supply is actually falling, M2 is falling, while the balance sheet of central banks is soaring. Makes absolutely no sense.
Just to be sure I understand, aren't governments doing something of what you're suggesting, Daniel, in the sense, not by cutting taxes or eliminating them, certainly, but by giving, well, essentially paying large subsidies to keep individuals' incomes up and to keep companies afloat?
It is not the same. It is not the same. It is not the same to use the fiscal space to address some level of support for the unemployed and for individuals. Yes, they're doing that to a certain extent, but at the same time they're letting far too many, actually thousands of companies almost every day, fall, because those are the companies that don't have access to credit. Those are the companies that don't have access to those levels of subsidies. The micro companies, which are actually the fabric of most developed economies. So what ends up happening is that the businesses that actually benefit from these top to bottom policies driven by subsidies are actually the businesses that, to a certain extent, were going to survive the crisis anyhow, because they have enough capacity to look for those subsidies, to file all the information that is required in order to get them, that have access to credit, because many of the measures that governments are taking are aimed at allowing companies to take for more debt. But many companies don't have that possibility. Imagine a business that has a rented property and a couple of employees. Those are the ones that are collapsing as we speak.
Thank you. Thanks, Daniel. Now I'll turn to Thorsten and ask whether he agrees or disagrees with what he's heard from our two previous speakers, and perhaps also would just like to address the general question of what he thinks should be done. Thorsten.
Yeah, thank you very much, first of all, for having the opportunity to be on your show and to exchange some ideas about the current situation. Let me start by saying that a couple of days ago, I published a little article at the Mises Institute in Auburn, and the title is The Destructive Effects of the Coronavirus Relief Package. In this little article, I try to show that monetary policy is just a redistribution of wealth and income on a grander scale. And I'm afraid that the current policy run by the Fed and other central banks around the world will basically lead to a to an unprecedented redistribution of income and wealth among people, and the rich will get richer, and those less well off will be left behind. As you all know, the governments and their central banks have put together a mega bailout package, not only in the US, but in other countries as well. It means that central banks, in effect, provide huge financial support to the financial system and the economy. In fact, the central banks have provided a colossal backstop to financial markets. They inject ever higher amounts of central bank money into the financial system by buying up all sorts of credit instruments, not only government bonds, but also mortgage, corporate bonds, commercial paper, etc. And so, in particular, the Fed thereby props up financial asset prices, keeping the cost of credit artificially low, and most importantly, avoids payment defaults on a grander scale. However, all these policies lead basically to a redistribution of income and wealth. And this kind of policy is not meant to increase the economic productivity of the economies. It is just a redistribution of income and wealth. And of course, you can uphold the current system, prevent the system from collapsing, but the consequences will be felt in the years to come. Income inequality will rise. People will feel that the government becomes, if it's not yet a deep state, it will become an even deeper state in the future. So the rescue programs, which are run across major countries at this moment, will basically put away with what little is left of the free market system, replacing it with a state-controlled economic planning system. And I think that is the biggest cost to these crises, which has in effect been caused by governments dictating a lockdown. And so I'm very critical about what's happening, and I'm afraid that the consequences of these policies will come to haunt us in the years to come.
Thorsten, I'd like to have a very quick supplementary there. I think probably the two previous speakers would agree with a lot of your analysis. My question here is, what about the incentive effects on people's economic behavior, the economic behavior of ordinary people earning, saving, and hopefully investing? Of the kind, what are the incentive effects of the kind of economic structure you're talking about? Decisions that have been taken by governments in the last 3 months?
Well, it's hard to say. I mean, on the one hand, I could imagine that people become concerned about, government, expanding at the cost of effectively private property rights. That we have set a precedent in which may be followed by other government interference going forward. I could well imagine that this lockdown blueprint might be adopted by those who are very concerned about our climate, and we're gonna see a repetition in which governments and political activists press for imposing certain limits to our economic activity, pushing back our economic freedom going forward, and that I think could be a concern on the part of many investors and even consumers to return to their investment and consumption behavior in the pre-crisis period.
I was thinking principally of savers. Will people be more incentivized to save because the future looks so risky, or will they decide that saving is pointless because there's no way you get a return on what you save?
I mean, if we assume that people look through this kind of policy schemes being imposed on them, I would very much expect that people become discouraged in terms of, putting away their incomes for saving purposes, because interest rates are basically low in real terms. They have become negative. The outlook for being rewarded through savings dwindles. And again, this kind of policy, as I said earlier, is not meant, from my point of view, to improve the economic productivity of our economies. It basically tries to uphold the status quo, and the status quo is an economic system which has been suffered from a government intervention on a grander scale of a kind of monetary policy that is debasing the purchasing power of money. So I would think returning to a policy which improves savings, which encourages investments, needs a far-reaching reform. In particular, our monetary system has to be reformed going forward.
Thank you. Would either of the other two speakers like to come in and comment on each other's speeches or on what Thorsten has just said?
Sure, if I could. Is that all right, Daniel? Okay, so something that Thorsten said I think is very important. Everything I made, all the comments I made initially about optimal Fed operation versus aggregate supply versus aggregate demand conditions is all taken from a textbook, and it all has and it all sort of skips over the unintended consequences and the unseen costs of these sorts of policies. I think so. Three quick things. The first is that I think as much as in the United States and especially in the New York area, we want businesses to be reopened again. I'm torn because I think one of the worst things that could happen from a long-term perspective would be for the economy to be reopened and everything to go back to normal. I would hate for our political figures to think that they have a new tool in their implementarium, that the economy works like a light switch, whether by luck or convention, and things get back to normal, and then they have this new tool that they can employ in the future. I mean, I think that would be a really pernicious situation if they were to learn that lesson. Another thing is that while at the same instance, a lot of policymakers are talking about the how dangerous some of these new ideas are. We've seen the last 2 years in the United States the promotion of these ideas like a jobs program and all that sort of thing, and UBI. Essentially, the policies that are being pursued right now are doing more for the MMT people than any of their books ever could. I worry that in the same way that the 70s were, in a sense, not completely, the death of Keynesianism, we are right now laying the foundations for future MMT initiatives more than, say, the books and the papers that are being written now ever could. So I think some of the unseen costs are going to be in terms of what the incentives are for governments going future, and also what lessons they're inadvertently teaching. Not only future governments, but also academics, scholars, financial markets, professionals, and so on.
You're prompting me. Let me ask Daniel to come in here if he wishes.
Oh, I think that one of the key outcomes of this type of policy is fundamentally that savers decide to take a much more aggressive approach towards being prudent. All monetary policy right now is what it's trying to do is to de-incentivize savings and to try to push investors to take more risk at lower yields. What excessive monetary policy, and particularly in this environment that we have outlined, and I agree with everything that Thorsten and Pete was saying, is that what it does is the opposite, is that investors become significantly more prudent. They go to the lowest risk asset. That's why you have a completely unusual level of yields in sovereign bonds, even with central bank action. The level is completely unjustified. And at the same time, what happens is that most citizens are being told that saving is antisocial. I just I came an hour ago from an interview in which somebody else, a very prominent socialist economist, was saying that what's the real problem right now is that the excess level of savings in the Eurozone and US economy. Think about that from the perspective of what is being fed to the population. The second thing that is being fed to the population is that there's no problem of, there's no issue with money, that you can print and you can issue all the money that you want. Therefore, when this doesn't work as intended by governments, and I will tell Pete it's not going to work, shutting down the economy and bringing it back to normal. When it doesn't work, the message that people will receive is, hold on a second. So $6 trillion, $7 trillion were spent where? Because I didn't see it, you see? And therefore, the perception that we already saw in Japan in the early 90s is that all of that money has been spent somewhere else, but citizens have been left behind. Not that productivity has gone down the drain or that the money velocity is collapsing, none of that. It'll be that a lot of money was spent in a recovery that didn't happen and citizens didn't receive it. As such, citizens will likely be inclined not to save because they will feel either the confiscation or the lack of return of those savings. And at the same time, the foundation for all those MMT magic solutions is already being laid out. When people are receiving $1,200 from the government coming from nowhere, most of them, and actually what you read in the press almost every day is, oh, it's not enough. It should be 2,000 or 3,000. They're not thinking it's coming from nowhere and it's actually nothing. They're thinking it's not enough. So that is what's likely, in my opinion, going to happen. A massive disincentive to save and a giant move towards the safer assets relative to the riskier, which will inevitably may generate a big collapse in many emerging market economies.
Just a very quick follow-up there, Daniel. Can you tell us the argument that was used to you earlier today by the socialists, that savings are, so to speak, a bad thing, and tell us and knock it down?
Oh, it's ludicrous, but let me tell you. Basically, this person's view is that what central banks do is simply create reserves, and the more reserves that they create, the better, because that is good for everybody. Therefore, what central banks should do is create reserves to people, which is give money directly to people. What he was saying, therefore, is that if the central bank and the government is so generous as to create reserves for you to hold them is antisocial.
Okay.
I'm sorry, because it's so ridiculous. But the unfortunate thing is, it's so ridiculous. But the unfortunate thing is that you have people with pedigree out there, like Mr. Zuckman and people like that, who are saying, oh, we will generate all this massive savings for you, and what you need to do is spend it, and if you don't spend it, then we'll tax it away, because if there's any inflation, it'll be because you, evil person, saved too much and generated a problem in the economy.
I'd like to turn now to Thorsten, and in fact to all three, and ask a question that steps back a little, because it's a very simple Simon question. I'm talking to three monetary economists. I'm not one myself. The rest of us dimly grasp what Keynesianism was. We dimly grasp what free monetarism was. What, however, we don't fully now understand in any simple, direct way is what the devil quantitative easing is and what modern monetary policy is. It sounds to me, when I hear it, that it's just a question of printing more money, which is what you more or less just justified, Daniel. Well, shouldn't we expect inflation to be the result, hyperinflation, given the amounts of money? Perhaps I could ask Thorsten to answer that first, and then the rest of you, two of you, could come back.
Yeah, thank you very much, John. while listening to you guys, I came across a quote by Ludwig von Mises, and he wrote down these words in January 1923. And let me quote, Mises noted, "We have seen that if a government is not in a position to negotiate loans and does not dare levy additional taxation for fear that the financial and general economic effects will be revealed too clearly, too soon, so that it will lose support for its program, it always considers it necessary to undertake inflationary measures. Thus, inflation becomes one of the most important psychological aids to an economic policy that tries to camouflage its effects. In this sense, it may be described as a tool of anti-democratic policy. By deceiving public opinion, it permits a system of government to continue, which would have no hope of receiving the approval of the people if conditions were frankly explained to them." Quote ends. And John, this is exactly, I think, what's happening right now. All these mega bailout programs boil down to money printing. For instance, governments are willing to make up for lost incomes. They would like to transfer payments from their coffers onto consumers to the corporate space, but they don't have this money. And what they do is they issue new bonds. And these new bonds cannot be placed in the capital markets because people are not willing to buy into such a big amount of new government debt. So all these government bond supplies goes into the central bank balance sheet. And basically what happens is that the central banks print up new monies, hand it over to the government, and the government spend this kind of money. And you can see the first effects of this money printing policy being revealed. For instance, in the United States of America, the monetary aggregate M1, that is basically cash in circulation plus demand deposits, rises at an annual rate of around about 26%. 26%. And presumably that's just the beginning. And what I would like to hammer home, the point I would like to hammer home, all these mega bailout programs boil down to money printing. It's just an increase in the money supply. And this is, of course, or it will lead to a redistribution of income and wealth. Those people who own stocks and housing and real estate are most likely the beneficiaries because the prices of these assets will go up. Those who are out of job and don't have a wage income and cannot expect their wages to increase in the foreseeable future are those on the losing side. So again, I just wanted to clarify that you cannot increase the wealth of an economy by printing up ever greater amounts of money. All that what's happening is a redistribution of income. John, if we could increase the economic welfare of an economy, we could basically wipe off poverty from this planet by just running the printing press. But this is, I think, a fatal error in economic thinking. But it is a policy that has been put into place not only in the United States of America, but also in Europe. And as I said, I'm not so much concerned about the economy collapsing in the near term. I'm more concerned about the economic and also the social political consequences this policy has in the years to come.
Peter, I think you're the next speaker here. Why don't I ask you to pick up the baton from Thorsten?
Yeah, I mean, so I agree, of course, with everything you said, and also with Daniel.
But you don't have to.
I just find myself in that position. It's difficult, of course. I mean, so the other thing is that it's difficult for people, especially in a democracy, who are voters, to opt away from what looks and maybe in the short term seems and feels like free money. The lure is very strong. A quick word on monetary theory is that it's a young school of thought. The idea is that the basic idea is that every economy has a production possibilities frontier, and that essentially inflation only erupts when you pass that. And so it's very difficult, I've found, because I've tried to engage them in some formats and via some media, sometimes on Twitter and otherwise. And many of them are very evasive. They're quick to dismiss your views, but not quick to really elucidate theirs. But the idea is that you can print money in essentially an unlimited amount until you reach a certain level, which passes this production possibilities frontier for the entire economy. And then what you do is you simply tax it out. Now, some of the issues that I've raised are, so, I mean, first of all, we don't understand how these things work really explicitly. We don't understand exactly what triggers economy in different cases, other than, of course, printing a lot of it. And also, one of the things I've said is, if you're going to tax businesses or individuals different amounts, depending upon what the levels of, say, inflation are at different times, or if inflation, say, spikes up and then recedes and spikes up again, it will be impossible to plan economically. Economic calculation will be dead if taxation is essentially random and in random amounts and that sort of thing. So it's a non-starter, but I think that unfortunately, policymakers in the US and in Europe and certainly in other places in the world are slowly but surely building a foundation for those extremely pernicious monetary theories.
It sounds to me, Peter, though, that there is a corruption of one of Friedman's ideas embodied in what you've just been describing, namely the idea, I now can't remember what the acronym, how it goes, it's NAIRU, non-accelerating, the idea fundamentally that you can't accelerate the economy by accelerating the money supply. Once you have reached a certain point of a non-inflationary barrier. Is that right or wrong? And how come that that Friedman's been picked up and misused this way?
I'm not. It's been a while since I read all that, so I'm not especially familiar with that. But it seems to me that the core view of MMT is that inflation should not be a concern in terms of monetary policy. And also another part of it is that and this also, there's on the fiscal side as well. I know we're talking about monetary policy here. Is that MMT people also believe that essentially, as it was described to me, a carpenter can't run out of nails. Essentially, that money is a measuring stick, and that essentially it has more to do with expectations, and also just trying to get the economy to operate at a certain level. How exactly? I've looked more at that in juxtaposition to, say, Austrian business cycle theory and Austrian monetary theory than I have Friedman or monetarism. But
yeah,
perhaps Daniel can jump in. Or Thorsten.
Yeah.
I've had numerous discussions with the MMT defenders. MMT defenders always do the same thing. They first tell you that they don't defend anything, that they're just telling you what money is and what monetary policy is. They're just telling you what it is, which is false to start with, because they always recommend a number of things which are endless money printing. The second thing is the idea. This is what MMT basically is telling you is that monetary policy, the way that we know it right now, is putting a constraint on the economy. It's like a burden on the economy that is not allowing it to reach its full potential, that unemployment should not be something that existed and that you could print money to pay workers to do anything, that you could basically, monetary policy should not be in any shape or form constrained, because by that, what you're doing is generating larger problems afterwards. What MMT also tells you is that it's upside down economics. It's basically that the creation of money and government spending are the ones that lead the economy. Central banks create reserves, government spends, that stimulates the economy. Then the private sector comes into the fore and generates some growth. If inflation starts to pick up, you tax it away from the private sector. Now look at this from what it really is. This is confiscation in the simplest form. Money creation is never neutral. you always massively benefit the first recipients of money and hugely and disproportionately negatively impact the last recipients of that money. Who are the first recipients of money? Governments and the crony sectors, what governments tend to call strategic sectors. Who are the last recipients of the money? Savers, wages, as Thorsten was saying, etc. So basically, MMT, what it's doing is massively exacerbate that benefit that already exists to the first recipients of money, and hugely and disproportionately increase the disadvantage for the private sector, for wages and for savers. In any case, the other problem with MMT is that it's all based on lunacy and magic, because every time that you say, well, thank you very much, this is exactly what has been going on in Argentina for the last 5 decades, they tell you, oh, but Argentina is not a good example because Argentina doesn't have real monetary sovereignty, which is ludicrous. And then you say, well, what about Venezuela? Done the same thing? No, Venezuela doesn't work either because they don't have monetary sovereignty. So in essence, what they come back to, and that's the final point on MMT, is that no country really is monetary sovereign as they would like it to be, because the reason why the US can print so much money is because there is still demand for dollars, not because the government decides it. The problem of the current environment, you said it before, is differentiating between QE, printing money, the way that Argentina or Zimbabwe or Venezuela do. It's very simple. And the fallacy that there is no inflation, this really angers me, and sorry to be a little bit more blunt, but quantitative easing generates monster inflation. The inflation that it is creating is in financial assets. The fact that you have governments that don't have solvency to pay the bills of the next 3 months with yields that are in real negative levels or real nominal levels is in itself monster inflation. So it creates massive inflation in financial assets, coming back to the point of what Thorsten was saying. The other problem is the calculation of inflation itself. It is no coincidence that in the middle of this monster experiment of quantitative easing, we are being told by policymakers and by central banks and analysts that there is no inflation, when at the same time, the protests in the Eurozone and so many other countries about the rising cost of living are soaring. And that is because the things that we buy on a day-to-day basis, non-replicable goods, are actually going up faster than real wages, while in the calculation of inflation, when we put together food, healthcare, rent, electricity, and we add it and average it down with technology, leisure, travel, and phones, then inflation is very low. But if you look at the core goods and services that people pay for, not the core CPI, okay, not the core inflation that governments calculate, but the things that people pay for. Every one of us knows that when you speak with people, they say everything is more expensive. A friend of mine says that everything he earns goes down and everything that he pays goes up. That is the essence of what quantitative easing is doing, which is a massive transfer of wealth from the wage-driven economy and the savings-driven economy to the debt-driven economy.
And the government, of course, as well. Which
government, of course, is the beneficiary, the only true beneficiary. It's not even the crony sectors. It's not even the banks. Banks are completely obliterated. They're simply it's governments who win, and by presenting themselves as the solution to every problem that they create, governments are actually gaining power, because there's no other option. Is that the citizens rightly say out there, okay, so what is the option between what we have in the Eurozone and what we have in the United States? Oh, if we left the Eurozone and we had imagine in Italy, the leader, what would the government do? massively print liras like there's no tomorrow. What would happen to the lira? So so there's almost a quid pro quo globally by which citizens are accepting the dollar or the euro because the level of destruction of purchasing power is smaller than the level of destruction of purchasing power than that South Africa or Brazil or Argentina or Venezuela are implementing. You see, it's a game in which everybody loses, but there's only one winner, which is the government.
Well, actually, also, it's fair to say, isn't it, that if a government has a lot of inflation, but it's still less than any other government, it's going to walk away with money from the roulette table. Yeah. And let me move on to the next point, if I could. I've turned to Thorsten, though I think it's something you will all want to say. I want to ask the question. The three panelists today come from a certain tradition in economics. The rest of the economic establishment in central banks and governments are all at the moment asking the question, in the end, we're going to have to come down. We're going to have some kind of safe landing from quantitative easing and the vast injection of money that's been pumped into the economy. Now, I'm asking you, is there such a possibility, or are we doomed in some other way? And if there isn't, what is the nearest best thing to the right policy that can be implemented? I think, obviously, Thorsten, I think it's your turn.
Yeah, thank you very much, Sean. You're asking about whether there might be a hard landing or soft landing, whether we basically can solve this.
Yes, is there such a thing as a soft landing possible? Yeah. And if there isn't, what's the next best thing?
Yeah, well, when we talk about the current situation, and the two other panelists have made that pretty clear, we're basically talking about the structure of our monetary system, which is an unbacked paper money system, which has certain consequences. And, various economists have different opinions where this system will lead us to. There are some guys who would say, well, it is going to end up in hyperinflation and pretty soon. Others are concerned that, this kind of monetary policy system will basically do away with what little free market system is left, replacing it with a kind of state-controlled economic system. Basically, I belong to the camp who thinks that governments and the central banks will get away with it, that they again will succeed in bailing out the system. This mega bailout program, and assuming that the lockdown will come to an end in the coming weeks, I think may very well succeed in keeping the artificial boom going or returning. That is, they will succeed from my point of view, and I don't claim to have the correct view on it, because in a way it goes beyond the scientific realm. It's a kind of personal forecast I maintain that central banks and governments will succeed in transposing the economic and financial bust into yet another boom, and thereby preventing the system from collapsing. One thing, however, is certain from my point of view. The official currencies, be it the greenback, the euro, the Chinese renminbi, or the Japanese yen, will most likely lose their purchasing power. Not totally, but the purchasing power of these official currencies will go down, either because inflation on the consumer goods level will take off, or whether financial asset price inflation will take off. In both cases, the purchasing power of money is getting debased. And so I think one takeaway of our discussion really for the saver and investor is that the official currencies have never been a reliable means to store wealth, and they never will be. And I think this will become pretty obvious in the quarters to come. As I said earlier, the money stock M1 and M2 are rising at very strong rates. And this increased money supply meets a reduction in total output. And I would say this is the perfect recipe for higher prices. You have an increased monetary demand and a reduced output of goods and services. So to me, it would be a miracle if that doesn't translate into a debasement of the currencies. But again, when I say this financial bust will be turned into yet another boom, the underlying problem is not really getting solved. The problem is really postponed, and the debt level is increased. So the next hit will become even more dangerous, you know, for our freedom and our economic system.
Couldn't you sum up what you've just said by saying that although we may have avoided a crash, we are consuming capital, and instead of a crash, therefore, what we're going to get is a gradual rundown of our standard of living as the capital begins?
Exactly, John. I mean, governments don't pay for this mega bailout. It's the people who pay for it, because the government either issues a bond, which is then bought by, let's say, Joe Sixpack. And if Joe Sixpack buys a newly issued bond, a government bond, he hands over his money to the government, and the government pays unemployment benefits with it. So it's capital consumption, consumption of savings. And if the government issues a new bond, which is bought by the central bank prints up new money. And the new money is being spent. And so the outcome is a debased purchasing power of money. Either way, people pay for this mega bailout. It's not the government that pays for it.
Thank you. Peter, over to you on the question again of can we get a soft landing? And if not, what's the next best thing we can hope for? Oh, I can't hear Peter.
Sorry?
Oh, there we are. Sorry, I couldn't hear you. Yeah.
I didn't want to interfere with the recording. Okay, so I agree with Thorsten. I think that the predicting a hyperinflation has become something of a cliche, although I guess it's within the realm of possibility. But I would also, I would ask anybody who thinks that hyperinflation is the worst thing that could happen to ask any Argentinian entrepreneur what 15% inflation per annum feels like. You don't need a hyperinflation to destroy people's savings and make economic calculation and accounting and all those things essentially untenable. So I mentioned in the very beginning that what I saw was that the Fed seems to be addressing a supply shock with policy that you would use to address a demand shock. And I think that what we're seeing in one sense is sort of the unenviable outcome of an institution whose mandate has been growing for 100 years. And what I think we're seeing now is and so I said, there are three possibilities. One is that they don't know what they're doing. The second is that they misdiagnose a problem. To finish off on my third, I think that the Fed is using a tool that knows how to use, but it's also trying at the same time, this fits into the question, by the way, it's trying also to simultaneously balance the supply side disruption and the likelihood that maybe a liquidity shock turns into a credit shock with accommodating the US government's massive debt issuance. And in my view, by keeping rates on a lower side. And so that's what I think this is. I can't predict the future. Certainly, money supply is growing tremendously, as both Daniel and Thorsten said. But I think that, you know, we will have increased the U.S. government will have issued another $1 trillion in, I think, in the last 45 days. We're now at 24.9 trillion, and we're looking at a 1 to 3. I mean, you can't even predict anymore. $1 to $3 trillion budget deficit, 120 maybe trillion dollars in unfunded liabilities, which I believe will never be paid because they'll just refute those. But I think what we'll see is more and more. I think it will end with a whimper and not with a bang. I think there will be a point where the debt service obligation of U.S. government debt becomes untenable, and eventually that's when the U.S. government, in some shape or form, will go to its creditors and say, we can give you really lousy dollars, or we can only basically only pay back a tenth or whatever of the principal on our debt. And I think that's how it ends. In terms of the boom, I think maybe the economy reopens. We have the semblance of a return to normalcy, and all that does is kick the can further down the road for the type of thing that we're saying. I mean, there is definitely inflation out there. I see it everywhere. I also see a lot of people selling. Yesterday, I was driving near AIER, and I saw at least 3 motorcycles, RVs, all sorts of vehicles for sale on people's lawns. There's definitely a lot of hardship out there, but I think that we may see a soft landing this time, and it makes the future landing that much harder. And I think it's my view that debt is the issue which may eventually sort of trip up the U.S. and probably the EU as well.
We'll stop the roundabout altogether. Let me just ask you a very quick question here. About 100 years ago, we might have thought that in the circumstances you're describing, the US can't pay its debt. A country like Switzerland might have been in the catbird seat. Is there any such country today? And if there is, what is being in the catbird seat like in those circumstances?
I think it's Iceland or Liechtenstein. Iceland or Liechtenstein. No, I mean small countries that I think have. I mean, it's not difficult to be more responsible than the U.S. at this point. I mean, merely having 3/4 of your GDP in debt, for example, is responsible compared to the U.S. now that we're like 108%. So, what country would be in the catbird seat? I don't have the data in front of me, but I mean, I look at certain countries like certain countries in. I'm gonna feel dumb because I know there's a better answer, but I think the smaller countries, I am a big fan of Switzerland and Liechtenstein and Iceland and countries like that. It might be good to have control of your own currency though, because I know some of those use the euro. So maybe Switzerland. I don't know. I'm interested to see what Daniel and Thorsten say.
I'm turning to Daniel now.
Yeah. Well, let's start with where I think this goes. No. Mm-hmm. I think first, the idea that quantitative easing is inflationary on CPI, on official inflation, is a problem in itself, because then it justifies its existence. No, it is not inflationary. It is disinflationary. Why? Because all of that money creation is used to perpetuate overcapacity, to fund spending of current spending from governments, and it goes to debt. Therefore, it destroys capital, and destroying capital, it generates disinflation. However, it does generate massive inflation in financial assets, as I said before. So where do we go to? We already know. We have a country in the East, it's called Japan. We know where we're going. We are going there without limit. We are going exactly where the Bank of Japan has led Japan to. And the same situation, the same outcome, which is stagnation with very low inflation and very, very high debt. Can the US go to 270% debt to GDP? Absolutely it can, unfortunately. The problem of the rising imbalances in the financial and in credit markets is that this is not a game of who wins. It's a game of who loses first. And when you have central banks in China, in the Eurozone, all over the world, doing exactly what the US Federal Reserve is doing, however, without paying attention to the real demand of dollars and without paying attention to the financial balance of the country, that is how much capital comes into the country, that leads to a fundamental flaw of the monetary system, which is that the countries that fall into the trap of playing the Federal Reserve without being the global reserve currency cement the status of the global reserve currency. It is no surprise that in the last 15 years, the US dollar denominated debt of emerging markets has soared. Not because these countries are stupid and they don't recognize the beauty and the magic of MMT propositions, but because there's no demand or very little demand for local currency risk. So what happens when you get into a crisis like we are right now is that then you get the sudden stop. Is that on one side, you cannot pay your US dollar denominated liabilities because your revenues and your inflows of capital are coming down. And at the same time, when you refinance, you can only refinance in US dollar denominated assets. Unfortunately, the US can go, and in my opinion, will go the Japan way, like the Eurozone as well, because both systems are feeding off the savings of the rest of the world. And that doesn't take out the reality of what both of you were saying completely correctly, which is that the citizen in the United States and the citizen in the Eurozone will see the purchasing power of his or her wages and disappear, absolutely, or fade out. But what we're seeing basically is a monetary war in which we will probably end with one, maybe two reserve currencies out there, and none of them backed by anything, obviously.
Daniel, thank you. Now, this has been the most entertaining, pessimistic discussion I have. I just want to ask you, therefore, very quick answers to this one question. You are a bond villain of enormous wealth and power, sitting in some private island somewhere, looking at your diagnoses. Where would you put your money? How would you invest? What would you do? Daniel, you first, then Martin, then Peter.
Oh, if I was that villain, I would have a very easy trade, in my opinion. I would be long dollar, long gold, very short every emerging market currency, and wait.
Martin, I think, has disappeared. At least I can't hear him. In that case, Peter.
Martin, you mean?
I'm sorry, Thorsten. Forgive me, I was misreading.
Yeah.
Thorsten,
well, you said you enjoyed this pessimistic exchange of ideas. You know, as a final note, I would like to be constructive, and you know, I see some glimmer of hope. For instance, in the United States, some states have abolished the capital gains and value-added taxes on gold and silver, thereby offering their people an alternative to the US dollar. And I think this opens up the right direction. It is basically what Friedrich August von Hayek called the privatization of money, you know, to think about schemes that, you know, take away the printing press out of government hands, so to speak, to privatize money, to allow money to be established in a free market. I think that is the solution, and we all have to work towards this improvement, and I think we can solve many issues, many problems on this world. But for now, John?
Thorsten, you are much too altruistic to be a Bond villain. I hope that's not true for you.
Yeah, now comes the villain. What I would do is to remain long, and Pete may not agree with it, to remain long in US stocks, you know, as an effort to take advantage of this ongoing asset price inflation in the years to come, to avoid any holdings of official currencies, you know, in the form of time and savings deposits, and also reduce to a minimum your sight deposits for payment purposes, and to take a decent chunk of gold in your portfolio, because I think gold is the ultimate means of payment. It has been with us for thousands of years. Paper currencies come and go, gold remains. It cannot be devalued by central banks running the printing press, and it does not have payment default risk. So you are, I think, in a good position holding physical gold, not ETF gold, but physical gold, bars and coins. And the combination of these two asset classes, I think, should give you at least a good possibility to weather the coming storm.
Thank you. And finally, Peter.
Sure. So no, Thorsten,
to you.
actually, I agree on the stocks with a caveat. I would be long stocks, but I'd be ready to get out at a moment's notice. I think I read that as inflation creeps up, that's usually the first place where people put their money, and they usually catch a huge sort of run up. So actually, yeah, I would be long stocks, but with an escape route planned. Certainly, long gold, long silver, long cryptocurrencies. I would say there's a portion for that. I think, if anything, right now, cryptocurrencies sort of in some senses, you have to be discreet. There's many of them now. They sort of embody Hayek's notion of the denationalization of currency. And I would also say, yeah, gold, silver, Bitcoin, long stock markets, at least for a little while. And then also, I always go back to farmland. I would want to own something, some farmland, something like that, somewhere isolated, or at least where you can grow something somewhere that's arid, somewhere that's fruitful, that sort of thing. But I mean, generally speaking, I agree with both of what the other gentlemen said.
Well, gentlemen, I'd like to thank all three of you for being so helpful and informative on what's a very difficult set of problems. I'm now rushing out to follow your investment advice. I thank my colleagues in the Free Market Roadshow for arranging this, and from the Danube Institute here in Budapest, I'd like to wish you good day and best wishes. All the best.